everyone, happy Holi. Today in terms of JIIB, I am here with you to celebrate Holi along with some important sessions of JIIB. So my name is Niharika Walia Bhatnagar and I am with you with the area of JIIB AFM, and today we'll be covering a few important topics of JIIB examination. More or less I've covered the topics of numerical part. So let's begin, but before I begin my session, please share the session, like it, and along with this, subscribe to our channel right away, everyone.
Hello everyone, welcome to Officer 24/7. My name is Nehar Kavalia Bhatnagar and I'm with you with the area of accounting and financial management for bankers. And we are talking about May 2024 and this is our series for achievers. Acha everyone, what have we started with? We had started with a specific chapter called the depreciation. So I'm going to continue with depreciation with new numerical questions. So this is what we'll be considering in the particular class. First of all, if you like the session, go ahead and click it up. Like the session. If you had been watching my series, please like my sessions every single time you see the video coming up, because your appreciation is the first and the foremost thing that keeps us going on. Secondly, if this particular session is helping you, please go ahead and share it among your peers as well. Thirdly, if you haven't subscribed to our channel yet, then go ahead and subscribe the channel. So let's continue further and let's talk about depreciation in detail. I'm going to talk about depreciation from the point of view of numerical as well as from the theoretical point of view. Plus, when we talk about this particular chapter, there is depreciation. It's a super duper important chapter. This particular chapter is extremely important just because of the fact that this particular chapter has been asked in the examination not only from the point of view of case studies, but this was in the previous syllabus. It was in the module A, one of the most important modules which had greater weightage as compared to other modules. So now let's continue. Okay, so we were talking about depreciation and its accounting. Acha, what do you mean by depreciation, everyone? Depreciation is usage, wear and tear. For example, let's talk about it. I have my specific, I'm just using a specific phone. So if I'm using my phone, then this particular phone is used every single day. So if it's used every single day, its value is decreasing every single day, right? If I bought a phone today, now after 3 months, its value is going to decline. After 10 months, it's going to decline further. And after the particular time when the entire, I would say, when the entire models are changed, then the price goes down like further, right? So when a new model comes, the old model loses its price. The same thing happens with the cars and same thing happens with the machineries that are being used in the organizations. So it's way too challenging to utilize something like that. Now, when we talk about depreciation, how does it work? Acha, we have done this part yesterday, so the same slide is still available, just in case you haven't seen the previous class. And if you haven't, then go ahead and watch the entire series. I've covered from module A, unit 1 till now. So this is what you'll find in the previous class as well. What is depreciation? Depreciation is a non-cash expense. Why do I say non-cash expense? This expense is not paid to anybody else, but only you know कि अरे I am incurring expenses because I'm looking forward to my survival. है ना? Every business looks forward to it. The decrease in the value of an asset is due to its use caused by wear and tear or by any other reasons. So that's how we define the area of the depreciation. And always remember, depreciation is compulsory, right? You cannot skip the portion of depreciation. It is not voluntary. Once you start using an asset, it is depreciable. And there is no point where the depreciation is not applied. Secondly, we talked about the depreciation over the period of time. Acha, everybody, we talked about depreciation. Na? Do you know, before I proceed further, how many methods are there? In terms of depreciation, the methods which are covered in your book only. That is all the portion that I'll be discussing. The number one method that is given is original cost or SLM, straight line method, uh, or SLM method. Second method is called diminishing value method or WDV method. वैसे there are other names as well, but these are the most common ones: diminishing value method and WDV, written down value method. Then the third one is double declining. And the fourth one that is covered in the book is sum of digits. And the last one is units of production. That is based upon the units that you produce. So if you produce more units, more depreciation. You produce less units, so less depreciation. That's the entire crux of the units of production area. Sum of digits, there's a specific formula for it. Double declining is basically doubling your depreciation because of its usage. If it's used more, then the double declining method would be there. Acha. Moving forward towards the questions. So we are going to cover the area of SLM as well as the WDV. Acha, in the examination now they have started playing with us. They are asking the questions not only from the formulas but also from the point of view of the fact that they are asking the questions on what basis those formulas are made. Matlab, they are asking questions from the area of assumptions even. Smart work. That means people cannot just say, "Ki, nahi, nahi, ma'am, I know numerical more, I'll just do the numerical part." Or you can say, "Ki, nahi, nahi, I'll do the theory more because I'm good at theory." They are asking questions which are theoretical but taken from the numerical area. So that's the smart work that they are doing in terms of the IIBF examination. So how much prepared we are is something that we have to determine. Acha, so I've given you the entire brief information of all the particular operations. Now tell me everyone, what is the basis of calculating the annual depreciation in the SLM method? SLM method is also called original cost method. It is also called fixed installment method. So that's the third name, right? So what is it based upon? Salvage value, purchase price, estimated useful life, or all of the above? What is the basis for calculating annual depreciation? When we talk about the basis for calculating the annual depreciation, the scrap value is super important. Purchase price is again super important. Then estimated useful life is again a very vital part of it. So all these things are extremely important. So what makes the answer is all of the above are super duper important when it comes to the area of depreciation. Acha, how is the annual depreciation calculated in the straight line method? What's the formula? Purchase price minus salvage value, purchase price divided by estimated useful life, salvage value divided by estimated useful life, and then is purchase price plus the salvage value. What would be your answer, everyone? I think I might have to improvise the particular point. It is actually whatever your purchase price is under straight line method, whatever your वैसे तो B would be the answer, but normally there is one more point there. Whatever your purchase price is minus your, if there is a salvage value, then you consider it. If it is nil, then obviously this turns out to be 0 divided by the estimated life. For example, everyone, I bought a machinery worth rupees 20,000. By the end of fourth year, I can sell it for 4,000. And its life is for total 4 years. So in this case, it would be 16,000 is the total amount that you will recover from the machinery in over the period of time, 4 years. So technically, in this case, my answer is going to be rupees 4,000. Got it, everyone? So in this case, the answer is going to be the purchase price minus the salvage value, scrap value, or residual value. Any of these things divided by the estimated useful life of the asset. So this is what we consider when we are making this particular area. Now comes the next point. Why is the straight line method more relevant in for assets like plant and machinery? It considers the market fluctuations. It provides tax advantages. It assumes the constant, consistent performance over the useful life, or it allows for accelerated depreciation. What would be the answer? Why is the straight line? See, वैसे ना, if you look at the income tax department, it allows only the usage of SLM or the WDV method. Rest other methods are not used. This is an easier method. One of the easiest methods is SLM or straight line method. Okay, so why is this more utilized in this case? Basically it says कि if we talk about our business there, we will assume that throughout the life we are going at the same pace na. So in this case it is assumed that the constant or consistent performance is there over the useful life. Okay, now comes the very important question, that is, what is the primary difference between diminishing balance method and the straight line method? Okay, so in this case, what would be the answer, everyone? When you're looking at the primary difference, but one of the major differences between WDV and SLM is SLM says throughout the life have the same depreciation. Diminishing balance method says you have more depreciation in the beginning, because by the end of the life of the asset, it's almost gone. If I look at the depreciation of my phone, I just open the seal, 10,000 minus. If it's an iPhone, you bought it for 80,000, then obviously nobody is going to buy at 80. If you have just sealed open and then you didn't use it, maybe 75K. After a month, it will decline further. Maybe after 6 to 8 months, it would decline at 70. After 2, 3 years, we all know that we will get not more than 40, 45, or even less than that for that, right? Because once 2, 3 years have passed, the new the version of that particular model is available at the same price as at we are trying to quote. So technically, in the beginning, the depreciation is more, and by the end, it reduces further. This is the particular thing which diminishing balance method says. In the original cost method, whatever our original cost is, you find the depreciation and then the same depreciation is there till the end of the life of the asset. While in terms of WDV or written down value method, once the value of the machinery is chosen, the depreciation is charged in such a way that if the total amount is 10,000, say, your depreciation is 5% in the first year. So it would be 500 rupees in the first year. You are left with 9,500. Then in the next year, again 500 of the 5% of 9,500. Whatever your closing balances under the portion of WDV method, you choose the closing value and the depreciation is charged on the closing value. It is not on any other thing, but it is on the closing value. The diminishing balance method assumes a constant depreciation value. The diminishing balance method assumes a constant depreciation rate. Straight line assumes more depreciation in the early days, and the straight line method assumes more depreciation in the early days. वैसे तो straight line method assumes same value. ठीक है, they have the same value. While when we talk about WDV, it says the depreciation rate is same. The difference doesn't occur anywhere else. It is just the constant depreciation rate. Now, how is the annual depreciation calculated in the diminishing balance method? Purchase price divided by estimated useful life, purchase previous year's value into percentage, or purchase price minus salvage value, or salvage value divided by estimated useful life. How is the annual depreciation calculated? When we talk about the annual depreciation calculated, annual depreciation is calculated on the basis of in WDV. Whatever your closing value of the previous year is, you will always find the closing value and multiplied by the percentage of depreciation. And that particular, the rate remains the same, the value keeps on changing after every year. So depreciation overall will vary. So in this case, the correct answer will come out to be the previous year's value multiplied by the percentage rate. Now comes, what does more depreciation tends to occur earlier in asset life mean in context of the diminishing balance method? The asset increases in value over the time, the asset loses more value in the later years, asset loses more value in early years, or depreciation is constant throughout the life of that particular asset, everyone. What would be the answer in this case? We have just talked about it, and the example was an iPhone. The value decreases more in the initial years because you buy it and then you are using it, and then the value goes down. So once the value goes down, it's definitely gonna something that is going to hurt us. So right. So when we talk about this area, it's gonna be like that only. Now comes the asset loses more value in the initial years, and after that, once it's declined, it is declining only. Then you are mentally prepared case ki value, the value of the same is just going, the value of that particular asset is not going to have a sudden major dip. It is just in the beginning that you will find a major dip. In which situations is the diminishing balance method more relevant? When the asset is expected to provide consistent performance over its life, then when the asset is expected to give better performance in the initial periods, when the asset's market value is unpredictable, or when the tax benefits are a primary consideration. When we talk about diminishing balance method, when you are using it more in the initial years, and then it would be stabilized. So then, because in the depreciation in the initial years on the basis of rate would be more. If the value is high, then obviously if I bought an asset for 10 lakh rupees, now let's look at this. I bought an asset for 10 lakh rupees. The depreciation on it was 10%. So in the first year, the depreciation was way too high. It was 1 lakh rupees. Now I'm left with 9 lakh rupees. On the basis of this 9 lakh, again 10%, that is of 90,000 rupees. So I'm left with 8 lakh 10,000 rupees. Then if you look at the remaining 10%, then it is basically 81,000. Then you are left with 729,000. Can you see the point there? The depreciation is decreasing because your opening value or the closing value of the previous year is decreasing. So if the value is decreasing, the rate is always on the closing value of the previous year. So technically it keeps on going down, it is dipping. So you will always find more depreciation in the initial years and lesser depreciation in the later years. That is because the value of the asset is more in the beginning, and the rate is always calculated on the closing value of the previous year. Now, in terms of original cost, if it is 10 lakh rupees, this is WDV everyone. And if I show you the SLM method, if this is of rupees 10 lakh, na, so every time you will find the depreciation remains the same. In the first year, it is same. In the second year, continued with the same amount, because it is said to be 10% of your original cost, the cost at which you bought it. So we are left with 8 lakhs. Then you remove further. Then you are left with 7 lakhs. So you can see the difference. That is, the diminishing value method is more realistic. It says that when we are using thing, then the value falls down more, right? Now here comes a question, everyone. A company purchases equipment for rupees 50,000 with a salvage value of rupees 5,000 and estimated useful life of 5 years. What is the annual depreciation using the straight line method? 10,000, 9,000, 8,000, 7,000. Okay, so let's calculate this question, everyone. Showing you the method. Under SLM method, what is the formula? It is your cost price or invoice price minus your residual value divided by estimated useful life. So technically we have 50,000 minus 5,000 divided by 5 years. So in this case the amount is of rupees 45,000. You know, 45,000 divided by 5 years. So if the life of that asset is 5 years, na? So in this case, the answer comes out to be 9,000 rupees is the depreciation per annum. So over the next 5 years, we will depreciate rupees 9,000 every single year. So your depreciation is going to be this. Acha. Just a little moment is required. I'll just, this was the formula. Okay, it is actually annual depreciation is equal to, this is the amount So in this case, the amount turns out to be rupees 9,000 altogether. So this is how you can see it, everyone. We have the purchase price minus salvage value. Salvage value is also called residual value. Okay, done everyone? One more question to go. An office building was purchased for 2 lakh with a salvage value of 20,000. Estimated life is 20 years. Calculate the book value at the end of 10th year. 2 lakh minus 20,000 divided by 20 years. So technically annual depreciation is whatever your purchase price. You bought it for 2 lakh and you remove the salvage value of 20,000. है ना? And the life is 20 years. So technically that comes out to be 1,80,000 and you divide it by 20. So in this case, my annual depreciation is of rupees 90,000. And you are talking about the depreciation over the period of time. By the time we are hitting the portion of 10th year, it is actually 9,000. Yeah. The depreciation is of rupees 9,000. You know, if the depreciation is of rupees 9,000, so by the end of the 10th year, the depreciation till now would be 9,000 multiplied by 10. That means 90,000 is the depreciation that has been charged till the end of 10th years. So out of 2 lakh rupees, you remove the area of 90,000, what you're left with is 1,10,000 is your amount of machinery. ठीक है ना? So in this case, the answer is 1,10,000. Evening everyone, welcome to Officer 24/7. My name is Niharika Walia Bhatnagar and I am with you with the area of AFM. I hope I'm clearly audible as well as visible. Okay. If the session has been helpful to you, if the series entirely has been helpful, please go ahead and share this session along with this, like it as well. And if you haven't subscribed to our channel yet, then please do the same as early as possible. Okay. Now, as I told you, the next series has begun. That means we have started with our module B. है ना? No, actually we were done with the module B even. We have started with the module C. The module C, we have now moved towards the one of the most important chapters, that is ratio analysis. A chapter which is always asked in the examination. That too, not for some smaller amount of numbers ki the marks are little less that you can look forward to it, you can miss it out. No, you just can't. This particular chapter is super important due to its weightage in terms of case studies as well as the individual MCQs as well. Done? So let's begin with I hope now it is visible. Visible everyone? Super important plus case studies plus important MCQs. Matlab I expect at least 5 to 6 marks for your examination would be from here itself. Done? Okay, then let's begin and start with our topic, ratio analysis. This is one of my favorites. The reason is ratios is overall divided into the following parts. That is number one, liquidity ratios. Liquidity ratios means those ratios which are related to the area of liquidity. Second is solvency. Liquidity, solvency. Third is profitability and market test. Then is turnover ratios. There are some miscellaneous ratios as well. So you will find all these specific bases on which we define our ratios. So on this basis, you will be able to find out what we do about the entire area of ratios. Matlab ratios is basically finding a numerical relationship between two or more items. And while finding those numerical relationships, what are we doing? The numeric relationship is defined and understood uh, regarding the ups and downs. Maybe it has gone up in the last few years, maybe it has gone down, or if I say they have some ideal ratios as well, ki nahi, this ratio should be of this particular amount only. That's also something that you will find in ratios. So that's the basic crux, a little in-depth information regarding ratios. Okay, now here comes the first question, everyone. Today I have covered good number of questions and many of them are taken directly from the IBF book itself. Matlab as it is, the questions which are given in the book, I am starting with those ratios, those questions, so that you understand what kind of questions are there in the book itself. The basic purpose of the series is to let you know what kind of questions are asked in the examination. So I am covering the entire book, strictly covering the entire area, whatever has been there in the examination based upon the previous year questions plus the IIBF book material, so that you don't have a problem in terms of understanding what kind of questions are normally asked in the exam. Okay, everyone, here comes the first question. Accounting ratios help in interfirm comparison, intra-firm comparison, comparison with industry norms, or all of the above. Actually, accounting ratios is one of the tools of financial statement analysis. It's a tool for financial statement analysis. Interfirm, intra, comparison, all. The answer is all of the above. Okay? The answer is all of the above. Now, second point, debt service coverage ratio. I think this is somehow they love this ratio. Why do I say this? Because this particular ratio was asked in promotion exams. This particular ratio was asked in our regular exams as well, in our examination of JIIB as well. So I think I have seen this particular ratio having its importance like anything. And this is basically a ratio which is very judgmental. Why do I say this? Because when we talk about debt service ratio, na, it's gonna ask the person, Hanji, do you have the capacity from your profit that you can pay off your debts as well as your interest? If you can, then only I'll say ki nahi, you should be taking loans. This particular ratio talks about the area of ability of someone to repay the loan or not. So based upon this, what would be the answer, everyone? Judging the margin of safety available before there's a default in repaying the loan, judging whether the firm has borrowing disproportionate in its net worth, judging the capacity of the firm to service the interest on debt, or all of the above. It's not all of the above, because margin of safety and the capacity of the firm to service is just not something which they choose. In this case, there's only one point, that is B. That is judging whether the firm has borrowing disproportionate to its net worth. Okay? The answer is A. नहीं नहीं judging whether the company has नहीं, the answer has to be A itself. Margin of safety regarding default and repayment. नहीं, it is related to repayment of loan only. So the answer is A only. B talks about disproportionate borrowing. It doesn't talk about disproportionate borrowing. It asks you that what is the profit you have, and in context with your principal plus interest. Any kind of principal repayments that you have to make, or any kind of interest repayments, that is why it is called debt service. So you have, if before the default of repayment of the loan, what is the amount that you normally have in your pocket? Which one of the following is true, everyone? Both earning per share and PE ratio vary with stock market price. While calculating DE ratio, fixed deposits from shareholders are taken part of debt. While calculating quick ratio, current liabilities are not taken into account. This is not true. Debtors turnover ratio is higher if the company sells more goods on credit basis than on cash basis. Earning per share is related to the area of earnings of the organization, and PE ratio is based upon the market price of the particular organization. MPS upon EPS is the PE ratio. So I believe the first one is definitely not something that we can choose. Okay? So this is also not true. Uh, the debt equity ratio, I think this is correct. Why? Because debt equity, in terms of debt, what will we do? Debt is basically the long term loans that we take. Those are called long term debts. The long term debts are a part of debt in this era. So in this case, the correct answer is B. While calculating debt equity ratio, fixed deposits from the shareholders are taken as a part of debt. Which one of the following is true? Higher debt equity ratio increases the profit margin of the company. Debt equity ratio is an indicator of solvency. A high current ratio is always an indicator of efficient management, or depreciation is not an expense, should be excluded from while calculating profitability ratios. Okay. When we talk about debt equity ratio, debt equity ratio will be higher if we get more debt. It is related to the era of solvency ratios. Acha, there is one more point. I'd written solvency ratios already. Yes, I didn't miss it out. I was thinking I missed out the solvency, but we did it. Acha, now the answer in this case, it is an indicator of solvency ratios. वैसे तो it is related to the area of solvency, but a high current ratio is always an indicator. A high current ratio is never an indicator of efficient management. High current ratio simply means that sometimes you have kept too much of liquidity in terms of your organization, which is definitely not correct. The answer is B only. That the debt equity ratio is an indicator of solvency of a company. It's B. Given? Which one of the following statements is correct about fixed assets ratio, everyone? It is ratio of fixed assets and net worth. It is a ratio of fixed assets and long-term funds. It is a ratio of less than 1 indicates short-term resources have been diverted for creation of assets, or none of the above. Which one of the following is correct about fixed ratio? Fixed asset ratio. Fixed asset ratio talks about the organization funds which are involved exclusively in the area of the assets. So this is basically the assets that you have built with your long-term funds. The answer is B, everyone. It is the ratio of fixed assets and long-term funds. Done. Here comes the next question, everyone. This question relates to the area of net profit can be greater than operating profit. When the net profit can be greater than operating profit. Actually, operating profit and net profit has two differences. It has only one major difference. Operating profit talks about only and only that part of the profit which the organization is making because they are working. They are working, they are operating their business. So operating profit is the money exclusively generated from the business, while net profit is the general funds that you are generating. Then what would be the answer? Cost of revenue from operations is more than operating expenses. Operating expenses are more than non-operating. Non-operating expenses are more than non-operating income, and non-operating expenses are less than this. Okay, when we talk about the operating profit is more, that can be more because the non-operating expenses, the ones which are related to the businesses which are not because you are operating in the business. That means it is not related to the business. You might have got some money in the business and you would have put it in the FD. Now from an FD you will receive a good interest. What is the expense? There is no expense in it. So in this case, what will happen? More of non-operating income will be added and non-operating expenses almost nil. है ना? So in this case, the correct answer would be where your non-operating expenses are more than the non-operating incomes. Answer is D, everyone. Then here comes the next question. The question says opening inventory of a firm is 80,000, cost of revenue from operations is 6 lakh, ITR is 5 times. Its closing inventory it will be 1 lakh 60, 1 lakh 20, 80 and 2 lakh. Opening inventory is given, cost of goods, cost of revenue from operations is also given, but they haven't given that part. Okay, let's try this question. Your ITR is equal to COGS upon average stock. Your COGS is given, which is of 6 lakhs. Your ITR is given, which is 5. But your average stock, for the time being, I'm taking it as I don't know about. So then you take average stock on the above side. Then it will come out to be average stock is equal to 6 lakhs divided by 5. So that would be 1,20,000. Now this is the average stock. Average means first year plus second year divided by 2. So this is basically 1,20,000 is the average, which is opening stock plus the closing stock divided by 2. That is how we find the average. So in this case, our opening stock was of no issue. The value is of 80,000, everyone, plus nil. Actually, not nil. We don't know about it. So I'm putting it as the number X. And when we talk about the value of this question, it is 80,000 plus closing stock divided by 2. Now from here, we will calculate the exact answer. This will turn out to be 2,40,000 minus 80,000 is equal to closing stock. So the closing stock comes out to be amount of 1,60,000. Done, everyone? Just look at the question. I hope it is helpful for you. Just give a quick look to it. You will be able to understand the concept. And let me know if you're all done with it. Done, everyone? See, in this case, first of all, I had to apply ITR, then I had to apply average stock formula, and then we calculated the entire situation. Then we calculated the entire answer, right? Done, everyone? Let's move on towards the next question. This was 1,60,000. Acha, ROI is calculated under liquidity, solvency, profitability, or activity. Activity is also called activity turnover ratios, everyone. We have talked about all these ratios already. Return on investment means whatever money I have invested in the business, in how much, what is the amount of return that I'm getting from that amount that I've invested. What would be the answer, everyone? Liquidity, solvency, profitability, or activity? The answer in this case, ROI. ROI is based upon profitability, everyone. ROI is basically your profit divided by the capital invested multiplied by 100. So the percentage which you get is called profitability ratios, because you're talking about the returns that the organization can make from their business. Done now? So profitability ratios are those ratios which are related to the profit of the organization. How much profit they are making after investing good amount of money in the business. Next question. Assertion and reasoning based, everyone. Liquidity ratios are used to assess the short term financial obligations of the firm. Current ratios and asset test ratios are two liquidity ratios which measure the firm's applicability to meet its current obligations in time. In the context of the above two statements, which of the following is correct codes? Both are correct, but R is not the correct reason. Both A and R are correct, but R is not the correct reason. Then we have only reasoning is correct or both are incorrect. Think about it, everyone. What would be the answer, everyone? Liquidity ratios. Liquidity ratio is just to find out whether the organization can pay off the loans or not. On a shorter basis, will they be able to do it? Then when we talk about current ratio and then the asset test ratio, these are both liquidity ratios which talks about in how much whatever money we have in terms of the payments which they are making, right? Asset test ratio or current ratio talks about the current assets which you are holding for less than 1 year are covered under this. Done, everyone? Everybody, no idea? When we talk about liquidity ratios, it is related to the short term funds only, and current and asset ratio is also related to the area of the short term. All these ratios are covered under liquidity, so they technically both are correct. The reasoning as well as assertion, both are absolutely correct. There is no mistake in it at all. Everyone, current ratio is liquidity ratio, liquid assets upon current assets, fixed assets upon current assets upon current liabilities, or liquid assets are divided by current liabilities. Current ratio is current assets upon current liabilities. So the correct answer in this case is C, that is current assets divided by current liabilities. Acha, everyone, if the GP ratio is 20%, goods for 50,000 sold to employee at the cost which will decrease the ratio. There will be no change in gross profit ratio because both the cost of revenue and revenue from operations will be increased by the same amount. You know? What would be the answer, everyone? Is it both are correct? Both are incorrect? Then everyone, what would be the answer? GP ratio based upon production. NP ratio based upon the sales that you are making out of that production. What would be the answer? Go ahead. GP ratio is basically the ratio which is strictly related to the area of a trading account, while NP ratio is something that gets into the answer in this case is actually both are the in terms of this A is correct and the reasoning is not correct. The reasoning is definitely correct because uh, there's a there's a growth which is somehow lopsided in our country, where you will find that in some areas there is an access to all these things, but when we talk about the other areas there can be scarcity as well, है ना? Done, everyone? Everyone, A is correct but R is incorrect. Done. Acha, let's end this particular session here itself. But before I end my session, Have you enrolled in our courses yet? If you haven't, then please go ahead and hurry up because the time is ticking away. So the best thing is to utilize this particular time so that we can learn a lot of things in this very limited area of working. So what you can do is you can take up the JIB May 2024 batch. Today we are starting with another batch that is at 7 p.m. I'll be starting with the topic of resolution JIB AFM. So if you're looking forward to it, click on the area of buy now, use the code Y541 and purchase your AFM module or the complete on that very basis. So when we talk about 6 months, you're getting it for 4913.79. So you can try it out. If it doesn't work out, then don't use. Good evening, everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the area of accounting and financial management for bankers. Acha, everybody, in this series, I think we are just about to end the module C as well. Till now, I have covered almost all the chapters of all the chapters of module A, all the chapters of module B, and now moving on to module C. Let's deal with it, everyone. In terms of module C, what are we dealing with? Number one, I'll be talking about two chapters today. The first one is capital investment decisions, term loans, and equipment. And the second one is, the first is this part, that is capital investment decisions or term loans. And the second chapter that we'll be talking about today is equipment leasing or lease financing. Capital investment decision is basically related to what? Pata hai, I've got a phone, but how did you buy a phone? Do you just go and buy the phone? Or before buying the phone, or buying a laptop, or buying any technical equipment that you are using currently, you will make a lot of efforts. What kind of efforts are we going to make? We'll try to find out the features of that particular product. What is the price that we have to pay for that? And what exactly are the benefits, pros and cons of the particular thing? What is the total of everything, I would say, each and everything regarding that particular uh, organization, about the particular warranty period. We are going to consider so many things. Matlab, in terms of phone, I'll buy a phone which has better resolution, is at least 5G. Right now every phone is 5G, so it should be 5G, it should be of the latest technology, it should have a good camera, it should have a sturdy body. You don't want a phone which is so delicate that you hold it and it gets uh, cracked or has a problem. Low in maintenance, good battery life. These are the things that you already decide. But how much amount you're going to pay in that particular amount, how much benefit you can reap, because phones are important. But if I buy a phone which is extremely costly and it's not going to be covered from the income that I earn, then what's the fun of it? It's better to buy a phone which will be helpful for me in my working. That is what I'll do. That means my inflow will determine my outflow. If I'm going to earn good money, then I'll pay good money for my phone. That is what we'll do. Capital investment decisions are basically defining or working on certain projects, and you will be working on those projects only if you get good inflow. And if your inflow is more than what you're investing, only then you will say yes to it. Otherwise, you'll say no. That is what we define in terms of capital investment decisions or term loans. Second is equipment leasing. What do you mean by leasing, everyone? Leasing or lease financing is when I cannot afford to buy a new machinery. So what would I do? Since I cannot afford, I will take it on a rental basis and I pay rent on it. The lease is of basically two types. First is operating and second is financial. If I take a lease for maybe 1 year or 2 years, while the life of that asset is 10 years, 20 years, so that is operating lease. And if I take a lease which is for the substantial period of the life of the asset, for example, my asset is of 10 years of life. If it has 10 years of life and we are doing it for 6 years or 8 years, then considerable part of the life of this asset is covered in this. So technically, that is what we'll be considering here. This is financial. So when we talk about, this is called financial lease and one is operating lease. Okay, so here comes the first question, everyone. The question talks about the capital budgeting. How do we define the capital budgeting there, everyone? Okay, I hope the question is clearly visible to you. The capital budgeting technique, which does not require the computation of the cost of capital for decision making purpose, is NPV, IRR, modified IRR, or payback period. Capital budgeting decision. Okay, capital budgeting has two kinds of methods. One is discounted techniques. These are the modern ones because they consider time value of money, while we have something called non-discounted techniques. That means you will just take the value as it is. For example, if I'm going to receive 20,000 after 2 years, we will consider it, ठीक है ना, 20,000 is good enough, but you have to think from the point of view, in the next 2 years, inflation is going to still come. Whatever you are making, in terms of that, this 20,000 is not the same value as it is today. So technically, this would be a wrong approach. So how do we correct it? In this case, the correct answer is payback period. Okay. Now, how is a payback period? NRV is basically a discounted method. IRR is again a discounted method. Modified IRR is also a discounted method. Only payback period is based upon this. Payback period is like this only, everyone. If I have, for example, let's take it this way, everyone. I invested 40,000 rupees. This is my initial investment. Over the period of time, in the year 1, 2, 3, 4, I got 10,000 in the first year, then I got 10,000 in the second year, then I got 10,000 in the third year, and 10,000 in the fourth year. And if I ask you, and this continues like this, fifth, sixth, and seventh year, till seventh year, we are still getting the amount. But by what time my payback period is over? That means if I invested 40, by which year my investment is done? 10, 20, 30, 40, by fourth year. Or I can say if the cash flows are uniform. This is uniform cash flows. When your cash flows are uniform, you take your initial investment and you divide it by annual cash inflows. This means 40,000 divided by 10,000, giving you 4 years. In the next 4 years, I am going to recover this amount. This kind of method is called payback period. In this, you are not utilizing the fact that after 7 years, if you are getting 10,000, the value will not be 10,000 at that point of time. This is going to be lesser than what value of 10,000 is today. For example, due to inflation, due to the compounding of interest and all, over the period of time, the value of the cash increases or decreases. Now, that's a part which is to be considered here. So technically, payback period is a technique which is old, but easiest technique. There are two techniques which are covered under non-discounted. One is payback period, and the second one is ARR, accounting rate of return. Done, everyone? Now comes IRR method would favor project proposals which have heavy cash inflows in the early stage of the project, evenly distributed cash inflows throughout the project, heavy cash inflows at the later stage of the project, or none of the above. IRR is basically a situation where you are discounting everyone in the initial years when you are dividing something, because you are actually dividing it by 1 plus R. The formula is basically 1 divided by 1 plus R raised to power n. Whenever you have to do, find the present value of something. Basically, do you remember compound interest? In terms of compound interest, how did we find the amount? The amount was basically P 1 plus R raised to power n. Now this is my present value. Okay? Now over the period of time, when you are going from present to future, you will do compounding. You are doing compounding only now, because your 100 rupees will increase further. But if you are coming back from future to present, your value is going to decrease because interest has to be eliminated. So instead of multiplying with the principal, you divide it. This is your future value, present value 1 plus R raised to power n. You take it, future value divided by 1 plus R raised to power n, and this is our present value. So technically, in this case, if your number is lower and you divide it by a higher number, your amount is going to decrease further. But if I say in would favor a project, that means when we want the cash flows to be higher. Heavy cash inflows in the early stages of the project, because this number is the least in the beginning and over the period of time it increases further. है ना? Basically, inflows and outflows, it depends upon the inflows that you're getting, the outflows that you're getting. In the initial years, it is always better that you have heavy cash inflows in the early stages. So after discounting, you get a bigger number because your inflow is also big and your discounting factor is also a big number. Okay? So in this case, your total amount becomes bigger. Then in terms of the working after years, your inflow will decline and your discounting factor, which is multiplied, is also decline. Your amount will decline over the time. So the initial period is the one which is most favorable. Next point. While evaluating capital investment proposals, time value of money is used in which of the following techniques? Payback period, accounting rate of return, NPV, or none? In terms of while evaluating capital investment proposals, if I'm looking into the investment proposals, then payback period, ARR, NPV, or none. In terms of time value of money, NPV is the one. These two are non-discounted techniques. Answer is NPV, because this uses present value factor. Next point. There comes a project. A project has a net initial investment of 50,000 and is expected to generate a net cash flows of rupees 20,000, 25,000 and 30,000 the next 3 years, everyone. Matlab, in the next 3 years, your initial investment was of rupees 50,000 and in the next 3 year you are getting 20,000, second 25,000 and third 30,000. If the company's cost of capital is 12%, we're just talking about 12%. You know? So in this case, it is 12%. Okay, let's see. If I have a calculator, no, the one that I currently possess is not the one which has discounting factor. So what I'll do is I'll get a particular calculator for you and we'll show it in the revision class there. Okay, how does it work exactly? Till then, let me give you a particular view about it. Okay, I cannot share the calculator with you. It's not picking up. So I think let's do the topic only. Acha, let's do this. What you can do is you can open up your calculator and try this up. What you can do is you divide in terms of finding the discount factor. I told you in this case we divide. It is basically 1 divided by 12. And this is 1 plus 12%. It will give you 1.12. 1 divided by 1, 2 for the first year, 1 divided by 1, 2 for the second year, 1 divided by 1, 2 for the third year. You try to find this up. And how do we do it? Not every time you can do that now. First of all, this is 1 divided by 1.12. This is 1 divided by 1.12 square. Then we have 1 divided by 1.12 cube. So you cannot do the square and cube and then divide it. It's a very long process. So just click on 1 divided by 1.12. Okay, I'm doing this with you, everyone. 1 divided by, I'm just clicking on the same amounts, 1.12. For the first year, it comes out to be 0.892. This is equal to 0.892. Now do nothing. Just click on equal to again. you will see this will give you 0.797. If it is not giving, you are not using the correct calculator. This calculator does not have the discounting factor. Okay, now the next point, if I'm clicking on it again, I will get 0.711. This is 0.711. So in this case, what I'm going to do is 20,000 into 0.892, and this will give me an answer 20,000 into 0.892, that is 17,840. This is the first term that you have to use. 17,840. Take it up, and to save your time, what you can do is, Acha, I hope this is visible. To take your time now, just click on memory plus. It will go into the memory of your calculator. It will itself add it up. 0.797 into 25,000 gives you 19.925. 19.925. And last, that is 1 divided by 1.12. अच्छा हो कैसा वो तो. This is 30,000 multiplied by 0.711 gives you 21,330. This is 21,330. And put it in the memory. So total comes out to be my answer comes out to be 90. This actually comes out to be 59,045, and your initial investment was of 50,000, and what you're going to earn in the upcoming years is 59,000. So technically this is 9045. Nearest is 9042. So this organization is going to make 9042 in terms of the returns, which is a good point for this organization. है ना? That is what we'll be taking up in this case. Done, everyone? चलिए, then this is the answer. So your answer comes out to be 9042. You just find the nearest one, and that is how you calculate it. In terms of the calculation of this part, what you can do is 1 divided by 1.12 on your calculators, everyone, and then you get the first value. Click on equal to again. You will get the second discounting factor, you get the third discounting factor, and then you multiply it with this and you will get the answers. Okay? Which of the following is not a source of funds for meeting the cost of purchase of fixed assets by an enterprise? Credit by the supplier of assets, internal accrual, debentures, or DPG. These are not source of funds. We get funds from these, we get funds from, this is our savings, and debentures is the loan that we take. So technically all these are, but deferred payment guarantee. Matlab we have given a guarantee, but the payment would be made a little later. Deferred means postponement. This is not covered here. When the purchaser of the fixed assets does not pay the supplier immediately, they're saying that can I make the payment a little later, but pays according to an agreed repayment schedule. They have defined a schedule and the bank guarantees this payment. This guarantee is called the DPG, Deferred Payment Guarantee. Which of the following ratio is indicative of the repayment capacity of the borrower in terms of a term loan? In terms of debt quick ratio is a current ratio. This should not be covered. Debt equity ratio can be taken up. Debt service coverage ratio and total operating leverage divided by the total net worth. In this case, the answer is going to be DSCR. This method is called debt service coverage ratio. In this case, this is a very judgmental ratio, but this ratio is accurate as well. This shows that if we have money, then to up to what extent are we having the debts that we are paying off. That means if I say that my total income was of 2 lakh rupees, and the debts that I have paid is of 20,000, and interest was, this is a principal, and the interest was of 4,000 rupees. So technically 2 lakh rupees would be divided by 24,000. Okay, this is the amount that I have to pay, and this is the amount that I have already taken from others as well as mine money. This is debt service coverage ratio. Do you have the capability to pay back? Right? Okay, I think I'll be skipping this bigger question. Now let's talk about lease first. I'll come back to the question surely, but a little later. Which one of the following is not a feature of lease? If I talk about lease, lease is where one party agrees to allow use of its property by another party. The lessee has right to purchase the lease property. It is for a specific period. It ignores regular payments by lessee or lessor for the use of property. It involves regular payments. That is true. But in this case, what will happen? One thing that is not there is the lessee has the right to purchase. You don't have the right. You can live in one particular house for years, and then if they ask you that where is the rent, and you cannot say this is, I'm not an owner of this. You cannot. Okay, there is no point where you get the right to purchase. It is again at the in the hands of discretion of the owner only. Nobody else can do this. Which of one of the following is a distinctive feature of wet lease? We have dry lease as well as wet lease. The leased asset is operated by the lessor. The leased asset is transferred to the lessee at the end of the period. The lease is for a long period, or lease can be terminated and at any time. When we talk about distinctive feature, that means this makes it different from others. In this case, the answer is actually the leased or asset is actually operated by the lessor. Until unless lessee doesn't come and say that whatever has happened with them was wrong, and then they take over this particular asset, then it's a different scenario. Then everyone, so next question: which one of the following is or are correct? Accounting treatment of finance operating lease is the same in the books, and accounting treatment of finance and operating lease is different in the books of the lessor. Lessor and lessee. Lessee may elect not to apply for Ind AS. So Ind AS is definitely there. All of the above are correct. They may choose or may not choose. That is still their choice. In this case, all the above statements are correct. You get a particular the particular lawyer in this or not, that is your choice. Even if you can get it on your own, you should get it on your own. Okay, this is about this entire chapter, everyone. I hope this session was helpful for you. Please go ahead and share this session among your peers and be there in the upcoming sessions as well. Your little efforts can definitely motivate me further to bring up new and new questions. So thank you so much. We'll be meeting on Monday now. Done, everyone. Bye bye.